If you observe carefully the behavior of the US dollar over the past 18 months, you'll notice something peculiar. While the headlines focus on inflation rates and interest rate decisions, the dollar itself is speaking in a language that most people don't understand. It's not screaming, it's not collapsing. It's doing something far more concerning. It's quietly losing the confidence of the world's largest creditors, central banks, and institutional investors. The stakes here aren't abstract. If you have retirement savings, a pension, or assets denominated in dollars, this message affects the purchasing power of everything you've worked decades to accumulate. This isn't a prediction. It's a logical consequence of decisions that have already been made and forces already in motion. I've spent over 40 years studying currency systems, debt cycles, and how reserve currencies rise and fall. When you understand incentives, you understand behavior. And right now, the incentives facing the United States government, the Federal Reserve, and foreign creditors are creating a set of pressures that point in one clear direction: a systematic devaluation of the dollar's purchasing power. Consider three specific data points that most people aren't connecting. First, central banks globally purchased 1,136 metric tons of gold in 2022, the highest level since 1950. Second, the US dollar's share of global foreign exchange reserves has declined from 73% in 2001 to approximately 58% as of late 2024. Third, countries representing over 40% of global GDP are now conducting bilateral trade in currencies other than the dollar. These aren't random events, they're signals. To understand what the dollar is telling us, you need to understand the fundamental mechanism at work here. Think of the dollar like a restaurant that's been the only fine dining establishment in town for 75 years. Everyone comes to this restaurant. But then the restaurant starts cutting portion sizes while raising prices. The quality of ingredients declines. The owners start handing out gift certificates to cover their own debts. At first, loyal customers ignore these changes. But slowly, gradually, some customers start trying other restaurants. They don't make a scene. They just quietly diversify where they eat. This is exactly what's happening with the dollar right now. The pressures creating this shift are mathematical and inescapable. The United States currently carries approximately $35 trillion in federal debt. The annual interest payment on this debt now exceeds $1 trillion for the first time in history, more than the country spends on national defense. When debt grows faster than the economy, there are only three ways to resolve it: drastically cut spending, dramatically raise taxes, or devalue the currency. Politically, the first two are nearly impossible. That leaves option three. Every foreign creditor holding U.S. Treasury bonds understands this math. History is an excellent teacher, and this pattern has played out repeatedly across different countries and time periods. In August 1971, President Richard Nixon closed the gold window, ending the direct convertibility of dollars to gold at $35 per ounce. Why? Because foreign central banks, particularly France under Charles de Gaulle, were draining U.S. gold reserves by exchanging dollars for gold. They saw that America was printing more dollars than it had gold to back them, financing the Vietnam War and domestic programs through monetary expansion. The U.S. had two choices: defend the dollar by raising interest rates and accepting a recession, or break the link to gold. Nixon chose the latter. Within the decade, the dollar lost over 30% of its purchasing power domestically. Gold, which had been fixed at $35, rose to over $800 by 1980. Foreign central banks learned a lesson. Paper currency promises can be broken when political pressures become intense enough. The 1970s inflation period that followed provides our second example. From 1971 to 1981, the U.S. experienced average annual inflation of approximately 7.4%, with peak years hitting 13.5% in 1980. Investors who kept their retirement savings in cash or conventional bonds saw the real value of their wealth devastated. A person who retired in 1971 with $500,000 in savings found that by 1981, that same amount had the purchasing power of roughly $220,000, a 56% decline in real terms. Meanwhile, those who held gold saw it appreciate from $35 to over $800, a 2,186% gain. Real estate prices quintupled during this period. The lesson wasn't that cash became worthless overnight. It's that it was slowly, systematically devalued over a decade, and most people didn't protect themselves until it was too late. because they trusted that the dollar would maintain its value. The 2008 financial crisis response taught us that currency devaluation doesn't always look like wheelbarrows of cash in Weimar Germany. Facing a complete financial system collapse, the Federal Reserve implemented quantitative easing, essentially creating dollars electronically to purchase government bonds and mortgage-backed securities. From 2008 to 2014, the Fed's balance sheet expanded from $870 billion to $4.5 trillion. Critics warned this would cause immediate hyperinflation. It didn't, at least not in consumer prices immediately. Instead, the inflation appeared in asset prices. Stocks tripled, real estate recovered and soared. The wealthy who owned assets got substantially richer. The middle class, holding cash in savings accounts earning 1% interest, saw their purchasing power erode as the cost of houses, healthcare, and education outpaced wage growth. This taught us that currency devaluation doesn't always look obvious. Sometimes it looks like your retirement savings buying less house, less healthcare, less security than it would have a decade earlier. The British pound's decline as the world's reserve currency is particularly instructive because it shows how gradual this process is. In 1900, the pound sterling was the undisputed global reserve currency, backed by the British Empire, the Royal Navy, and the gold standard. London was the financial capital of the world. International trade was conducted in pounds. By 1914, World War I began draining British resources, costing Britain approximately 40% of its national wealth. The country borrowed heavily from the United States, transitioning from the world's largest creditor to a major debtor. By 1931, facing bank runs and gold outflows, Britain abandoned the gold standard entirely. The pound was devalued by 30% in 1949, another 14% in 1967. By the mid-1970s, despite winning World War II, Britain was economically broken. Inflation hit 25% annually. The government required an IMF bailout in 1976. Today, the pound is used for less than 5% of international transactions. The transition took 75 years from peak dominance to secondary status. The pattern was clear. Enormous war debts that couldn't be repaid, loss of productive capacity relative to rising powers, political inability to make hard fiscal choices, and gradual loss of international confidence. The similarities to America's current trajectory are uncomfortable but undeniable. To understand what the dollar is telling us right now, you need to understand three fundamental principles. First, every paper currency is a claim on a government's future taxation and productive capacity. This works beautifully when the government's debt is manageable. It breaks down when the debt becomes so large that everyone realizes it can never be repaid through taxation or growth, only through inflation. Second, reserve currency status is a privilege, not a right, and it can be lost. The US dollar became the world's reserve currency after World War II because America emerged as the world's largest creditor nation. But reserve currency status creates a paradox. It allows persistent trade deficits. Over time, this shifts a country from being a producer and creditor to being a consumer and debtor. Third, governments always choose inflation over default when debt becomes unpayable, because inflation is a hidden tax that the public doesn't fully understand, while default is obvious and politically catastrophic. Let me tell you a story that illustrates how this plays out in real life. In 2007, two families both reached retirement age with approximately $1.2 million in retirement assets. The Johnsons kept their retirement savings in a traditional allocation, 60% in U.S. stocks and bonds, 35% in cash and CDs, and 5% in gold. The Martins rebalanced, 40% in U.S. stocks with international revenue, 25% in international stocks, 15% in real estate trusts, 10% in precious metals, and 10% in inflation-protected securities. Fast forward to 2024. The Johnsons' portfolio grew to approximately $2.4 million, but cumulative inflation meant this had the purchasing power of approximately $1.5 million in 2007 dollars. A real return of only 1.4% annually. Their healthcare costs tripled. Their property taxes tripled. They found themselves reducing their standard of living in retirement. The Martins' portfolio grew to approximately $3.1 million. Their international holdings benefited from dollar weakness. Their precious metals increased from $120,000 to nearly $380,000 as gold rose from $800 per ounce to over $2,400. Most importantly, their portfolio maintained its real purchasing power. This isn't made up, it's the typical pattern. Now let's translate this to what really matters, how this affects you personally. If you're 55 years old today with $800,000 in retirement savings, held primarily in dollar-denominated assets, a typical 401k with U.S. stocks and bonds, here's a plausible scenario based on the patterns we've discussed. Over the next 10 years, assume moderate official inflation of 4% annually, though your actual experienced inflation in healthcare, property taxes, and insurance will likely be higher, perhaps 6 to 7%. Your portfolio might grow to $2 million nominally, a respectable return that makes you feel good when you check your statements. But in real purchasing power, that $1.2 million will buy approximately what $720,000 buys today, a 10% loss in real terms, not a gain. Here's what this means for your daily life in concrete terms. The house you were planning to downsize into, currently priced at $450,000, will likely cost $670,000 in 10 years at 4% annual price appreciation. Your health insurance premium, now $1,200 monthly, will probably be $2,100 monthly. And that's a conservative estimate given that healthcare has historically inflated at 1.5 to 2 times the general inflation rate. The part-time travel you planned, 3 international trips per year at $4,000 each, will cost closer to $6,500 per trip as airfares, hotels, and the weakness of the dollar against foreign currencies compound. That's $19,500 annually instead of $12,000. Consider your grocery bill. If you're spending $800 monthly now, that's $9,600 annually. At 4% food inflation, that becomes $14,200 annually in 10 years, an extra $4,600 per year. Property taxes on your home, perhaps $6,000 annually now, could reach $10,000 or higher as municipalities face budget pressures. You won't be destitute. You'll still have your savings. But you'll find yourself making compromises you didn't anticipate, scaling back plans, worrying more than you expected about whether your money will last. You might delay healthcare procedures because of cost. You might visit family less frequently because travel is expensive. And the cruel irony is that you did everything you were told to do. You saved consistently, maxed out your 401k contributions, diversified within traditional asset classes, avoided excessive risk. The problem is that you were entirely exposed to one risk you didn't recognize: the systematic devaluation of the currency in which all your assets are denominated. Let's run the numbers on a specific example. Imagine you have $500,000 today, and you need that money to generate retirement income. Under current conditions, a conservative 4% withdrawal rate gives you $20,000 annually. If the dollar maintains its purchasing power, that $20,000 provides a consistent standard of living. But if the dollar loses 30% of its purchasing power over 10 years, a moderate outcome based on historical patterns, that $20,000 withdrawal now buys what $14,000 buys today. You'd need to withdraw $28,600 to maintain the same lifestyle, which is a 5.7% withdrawal rate. At that rate, you're depleting your principal rapidly, and you risk running out of money. This is the hidden confiscation that inflation represents. Nobody came to your house and took your money, but your money quietly buys less every year. Based on these principles and historical patterns, here are practical guidelines for positioning yourself. I want to be very specific because vague advice doesn't help anyone. For someone between ages 50 and 70 with substantial retirement savings who wants to protect purchasing power over the next 10 to 20 years, consider this structure. 40% in productive assets with pricing power and international revenue exposure. High-quality companies that can raise prices when costs increase, that generate revenue globally, not just in dollars, and that own hard assets or intellectual property. Think of companies in energy, materials, infrastructure, consumer staples, and technology with global reach. The goal here isn't maximum growth. It's maintaining real value through inflation. 25% in international assets, specifically emerging markets and commodity-producing nations, providing currency diversification. When the dollar weakens, assets denominated in other currencies become more valuable in dollar terms. Countries with strong balance sheets, commodity resources, and growing middle classes offer this exposure. You're not betting against America. You're acknowledging that America represents only 4% of the world's population, 15% in real assets, primarily real estate investment trusts, infrastructure funds, and commodity-linked investments. Real estate tends to maintain value during inflation because rents and property values adjust to price levels. Infrastructure often has contracts with inflation adjustments built in. 10% in precious metals, primarily gold with some silver. This isn't an investment that produces cash flow. It's insurance against currency devaluation. When central banks globally are buying 1,000 plus tons annually, they're signaling something. 10% in Treasury inflation-protected securities, or short-duration bonds for liquidity and stability. Implementation should be gradual over 6 to 12 months, using a systematic approach. If you have $800,000 to reposition, that might mean moving $65,000 to $130,000 per month. Dollar cost average into new positions. This reduces the risk of poor market timing. Month 1. Research and select international equity funds. Month 2. Identify real estate investment trusts. Month 3. Establish precious metals positions. Month 4. Rebalance domestic stocks toward multinationals. Continue this process until you reach your target allocation. The psychological aspect is equally important. You need to prepare yourself for the fact that in some years, this allocation might underperform a traditional 60-40 portfolio. There will be quarters when U.S. stocks rally, the dollar strengthens, and gold declines. You'll be tempted to abandon the strategy and chase recent performance. Your brother-in-law will tell you his portfolio is up 15%, while yours is only up 8%. This is where most people fail, not in the strategy itself, but in their inability to maintain it through short-term underperformance. Remember that in 2013, when the stock market was soaring and gold declined 28%, many investors abandoned their precious metals holdings right before a multi-year rally. The discipline to maintain a strategic allocation through performance cycles separates successful long-term investors from those who constantly chase returns. Common pitfalls to avoid. First, don't confuse this framework with market timing or speculation. This isn't about predicting when the dollar will collapse or when gold will spike. It's about acknowledging long-term structural pressures and positioning accordingly. Second, don't go to extremes. I've seen people read analysis like this and immediately put 100% of their savings into gold or cryptocurrency. That's trading one concentrated risk for another. The goal is balanced exposure across multiple stores of value. Third, don't neglect tax efficiency. Use tax-advantaged accounts where possible. Consider the tax implications of frequent trading versus long-term holdings. A strategy that's theoretically sound but tax inefficient can underperform significantly. Fourth, don't ignore your personal situation. If you're 75 years old and need current income, your allocation will differ from someone who's 55 with 20 years until retirement. If you have a pension that's inflation adjusted, you have less need for inflation protection than someone entirely dependent on their savings. Nothing in this constitutes specific financial advice. Each person has different circumstances, different income needs, different risk tolerances. You should consult with qualified financial professionals who understand your complete financial picture before making any significant changes to your investment strategy. Here's what I want you to understand philosophically. The message the dollar is sending isn't visible in day-to-day exchange rates. It's visible in the behavior of sophisticated actors, central banks, sovereign wealth funds, major institutional investors, who are quietly diversifying their dollar exposure. It's visible in bilateral trade agreements that bypass the dollar. It's visible in the mathematics of unpayable debt meeting political gridlock. The choice is yours. You can assume that the patterns that have governed reserve currencies throughout history somehow won't apply to America, or you can acknowledge the signals and position accordingly. But remember, China's central bank has increased its gold reserves every month for over 2 years. Russia has reduced its dollar reserves from over 40% to less than 10%. Saudi Arabia is accepting yuan for oil payments. Singapore, Norway, and Switzerland have been diversifying away from pure dollar concentration. These aren't conspiracies or predictions. they're observable facts. When the world's most sophisticated financial institutions are adjusting their behavior, it suggests they're seeing something in the data that the average American investor isn't focusing on. That's why this channel exists, to observe and share signals before they become obvious to everyone. Most people wait until a crisis is upon them before adjusting. They wait until inflation is at 9% before seeking inflation protection. They wait until the dollar has already declined 30% before diversifying. By that point, protection becomes expensive. The time to position defensively is before the storm, not during it. If this analysis makes sense to you, if you see value in understanding these long-term structural forces rather than just reacting to daily news headlines, I encourage you to subscribe to this channel. The dollar has been the world's reserve currency for 80 years. But 80 years isn't forever, and reserve currency status has always been temporary throughout history. Each believed their dominance was permanent. Each eventually learned otherwise. The dollar's message right now is subtle but clear. The era of unquestioned dollar dominance is ending, and the protection of purchasing power will require more than simply holding dollar-denominated assets and hoping for the best. You have time to adjust. The transition won't happen overnight, but the signals are there for those willing to observe carefully.